Good afternoon. I'm Peter Schwartz, Sportico's Senior Sports Valuations and Legal Reporter, and welcome to Sportico Live. I'm coming to you live from my home in Brooklyn, New York, home to the 1955 World Series champions. And let's dive right into today's topic, which is NFL valuations behind the numbers. So on our first edition of Sportico Live, we really got into our Sportico's proprietary NFL team valuations, which are a little bit different from what's out there in terms of us looking at the entire business entities. We look at the teams, we look at related interests owned by the teams, really a fair market value of if these entities were bought and sold on the market today. Today, we're trying to go behind the numbers, get a little bit more detailed about the process of valuations, and talk to key stakeholders related to the NFL and in the NFL ecosystem. And I'm thrilled that our first guest today, Alec Scheiner, partner at RedBird Partners, is here to join us. Alec has a lot of experience both in the football world and outside the football world in sports-related finance. So he was the president of the Cleveland Browns and the vice president and the general counsel of the Dallas Cowboys. And really, maybe I'm hyping you. I'm too much of your hype man here, Alec. But I'm thrilled at the insight you can provide. So welcome to Sportico Live.
Thank you. I'm excited to be here, Peter.
Well, so let's start with getting into a little bit about the nuts and bolts of valuations. So a lot of our readers have asked me, why are sports teams different? Why do you look at multiples of revenue when doing these football valuations and not multiples of EBITDA or other types of financial metrics? So how did that become the industry standard, and really why is that the industry standard today?
Yeah, well, the answer to that, I think, is pretty simple, Peter, which is up until about 20 years ago, there probably wasn't much EBITDA anywhere. And there was no other way to value these. And then I think the NFL was at the forefront of teams that had cash flow and had EBITDA. And you could have transitioned to, and I think people have transitioned to value them that way, but still they're kind of simplistic. What's the revenue multiple is the guide. I mean, you and I have talked a little bit about this. I actually think it goes deeper than that, and it goes into how people run these businesses. Mm-hmm. Because most of these businesses are really the same, especially in the NFL. I mean, the biggest revenue category is split equally among 32 teams. And then the question is, okay, what kind of history and brand does a team have? And then how do they operate on a yearly basis? And that includes how much success they have off the field and on the field. And I'm always fascinated to look at these rankings and the rankings you put together. And at some level, it's driven by market and legacy. But at another level, it's just driven by how good they are as operators. And that now comes back to EBITDA and cash flows and gets us moving away from the revenue multiple.
Interesting. So it's fair to say that prospective bidders, when they're looking and evaluating potential bids on football teams, they examine how they can build EBITDA and how they can generate larger cash flows. But the actual valuation itself is based on multiples of revenue.
Yeah, I think that's a really good way of saying it. So I think you understand you're constrained by precedent and kind of these historic valuations. And so you know you're not going to get away from that, even if the numbers are different than what you think they would be. That said, you go one layer deeper and you say, okay, if I invest X amount of money, what kind of returns can I get going forward? How do I grow this business? And some of that's as simple as how many more tickets could I sell? Some of it's as complicated as what kind of land can I acquire? How long will it take? What kind of stadium can I build?
And as our viewers are listening to your answers, I want to remind everybody that, as always on Sportico Live, please feel free to type your questions for Alec or for any of our guests today. And at the end of the show, we'll be taking them up together. So there's a chat function in the bottom left corner of your screens. Alec, I mentioned earlier about how you have some unique insight, being both in the football world, and while in the football world at two different ends of the spectrum of or close to two different ends of the spectrum of our valuations. You were at the Cowboys, which are at the very top, ranked first at $6.43 billion, and you have the Browns, which are not at the bottom but are in the lowest quartile of our valuations. So I'm wondering your experience in football in that way, and now also in the private equity world in sports from an outside perspective, the different vantage points that you have on viewing team value and how different stakeholders might view it a little bit differently.
Yeah, I think it's really fascinating. I started my career as a lawyer helping people buy and sell teams. And then I worked with obviously the most valuable sports franchise, I think, in the world. And then when I went to the Browns, I think they were, when I got there, they were even lower than they are now. And now I've gone back to the other side as looking at it from an investment perspective. I think there's three types of NFL teams, and it's probably the case for all pro sports teams. They're the kinds that are just happy to operate and put on a football game. There are less and less of those, but there's some. They're the kind that can maximize their core revenues, suites, sponsorships, tickets. And then they're the kinds that will invest outside of those core revenues, like the Cowboys did with their merchandising business, with the third-party event business, with their real estate business. And that's where you see the real dichotomy, I think, in NFL franchise values. Because again, if you kind of came from Mars and you looked at this, you'll say, well, they're splitting the most important revenue equally. And there's not a lot else going on here. And then if you look at what Jerry Jones and the Jones family have done with the Cowboys, you understand why there's such a gap between them and other clubs. With the Browns, what we tried to do is we tried to shore up the second category, sell more tickets, sell more sponsorships, enhance the economics. I think when I got there, we were close to a break-even franchise. And then when I left, it was much better. That will flow through to valuations over time, especially with third parties looking at the numbers.
Well, let's take a look at the valuations themselves. I'm going to fire up what our editor-in-chief, Scott Soshnick, called in our first Sportico Live event, the Levinator, named after Lev Akabas, who created this great data visualization of the valuations. So I'm sharing my screen now, and you can see if I look at the total value of all of these teams, the wheel spins. And then if I click on revenue and resort these teams based on revenue, I see that the Chargers are selected. But if you look at the bottom here, you have two teams moving into new stadiums this week, as a matter of fact. Then you have the Bengals, who I think are kind of an interesting example of what I'll call an old school team. And I don't say that pejoratively. I say that to be precise and accurate. There are certain owners that view running the business of a football team as the business of a football team. And you'll see they don't have a naming rights sponsor, and they have not really tried to maximize revenues in the way that the Dallas Cowboys have, as you mentioned. So I'm wondering, Alec, your insight on what some of these teams, maybe with the Chargers and Raiders aside, and certainly the Rams with the new stadium aside, but looking at the Bengals, here the Lions, the Bills and the Cardinals, all of those teams have more than 70% of their revenue is from national sources. The league average is 60%. What can they do to add more value and build their businesses at a local level?
Well, look, I think you identified it. I think every NFL team owner has to decide first and foremost what kind of business they want to have. And I think some of these rankings just reflect those choices. And I wouldn't say any of them are good or bad choices, right? I mean, you've got teams in NFL that say the most important thing we can do is win. Nothing else matters. And because of the economic model of NFL, you don't have to drive a ton of revenues to be able to win. And so if you look at this, there's some teams that make different choices than other teams. Some teams spend a lot of resources on driving revenue and driving EBITDA. Others say, you know what? We're a football organization. The best thing we can do is win the Super Bowl. Let's focus on that. Mm-hmm. What I find really fascinating across all of sport, but especially the NFL, if you look at the chart you created, there's some teams in the kind of the 10 to 15 range, right, that are smaller markets than teams in the 25 to 30 range. And then asking yourself how and why that has happened is really fascinating to me. And some of its history, some of its operations. I went back before this today and I just checked the 2000 Forbes rankings, 2000, right? Mm-hmm. And the Browns were like 4th or 5th of all NFL teams. And so I think we think of these things as pretty static. I think you've introduced an element of sophistication to these as well, but I don't think they'll stay static, because as teams sell or as different generations take hold of these teams, they'll have different priorities and they'll fluctuate through that list, I think.
But let's talk at the same time about how it's a little bit more difficult in the NFL to build your local market, to build value in your local market than it might be in some other sports. And by difficult, I don't mean to take away the extreme efforts that teams that don't rely so much on national revenue exude in order to sell their sponsorships and their tickets and all of the things they do to make it a viable business. But it's difficult. You and I have talked about the example of the Los Angeles Clippers versus, say, the Los Angeles Chargers, how it's difficult to build value in the NFL on a local basis when so much of your revenue from the get-go is from the national side of the coin. I think our viewers would be interested in your perspective on that.
Yeah, it is. It's a great equalizer, right? And it all comes back to media. If you buy a New York baseball team or basketball team, you'll pull the biggest lever, which is your local media deal. If you buy an NFL team in LA or New York, you get the same media revenues as the Cleveland Browns or Cincinnati Bengals. And so when you're one of these teams, you've got to get pretty creative with the other levers. And obviously that's what the Cowboys have done so well, if you think about it, right? Mm-hmm. Not only did they take the existing levers like seats and suites and sponsorships, they also introduced PSLs really for the first time at scale, merchandising they took back in-house, and then they developed a whole real estate component around it. And so I think it's, on the one hand, I think people love the predictability of the business and buyers love that. On the other hand, you do have to be pretty creative to pull extra levers to get to the position that Patriots and Cowboys have.
You know, we talk in our valuations report. I just think that this is such an astounding figure that had the Cowboys not sold a single sponsorship, had not sold a single hot dog, a single parking pass, anything of the sort, and only generated revenue, and to say nothing of their robust merchandise business, which is separate from the rest of the league that Alec referred to earlier. If you only look at their ticket sales, their deferred revenue from seat licenses and their premium seating, that's their luxury suite leases and their club seating sales, they have $300 million in revenue, which is greater than the local revenues from all sources combined of every team but the Patriots, which is $315 million. It's just remarkable. And I guess I'll leave you with this one question until Q&A, of course, is more of a theoretical question. But the morning our valuations were released, Sportico's own John Wall Street wrote in his daily newsletter a story citing our valuations that stood for the proposition that NFL teams in that bottom quartile. So we looked at some of them. And I would say mainly he was talking about teams beneath where the Browns were. So we're talking about the Bills, the Cardinals, the Lions, and the Bengals represent the best investment for a prospective owner in the NFL because of the debt and equity limitations or restrictions on ownership, because of course of the cost of the team, and also because of the potential to grow the team. So I'm wondering, if you were coming in today in a hypothetical world and were able to buy a team, are you buying that argument, or would you still rather be in the business of the Cowboys or the Patriots or one of the teams at the top or one of the teams in the middle?
Well, it's a good question. I couldn't afford any of the teams at the top, no matter what. So I'll set those aside. I think I would agree partially with what John said, but what I would say is I think you need to layer on, most importantly, the infrastructure opportunities. So let's look at where they are in their life cycle of the stadium. Let's look at what kind of state and city they're in, if they have the ability to build a new stadium, and let's understand the demographics of their fans. So not all of these situations are created equal. I always laugh, people often have like Carolina and Tennessee next to each other. They're pretty similar. They're very different situations. Different politics, very different fan base, and most likely two different buyers would perceive them very differently over time. So to answer it directly, I would look at those teams probably in the bottom half, and I'd figure out which ones have the biggest levers to pull over the next 10 years.
I think that's what they'd call in your old home state of Texas a high-class problem. And I want to thank you, Alec, for joining us. But please do stick around for later in the show. And let's now bring in the Sportico Live panel. Joining us is a professor and the academic director of Columbia University's Sports Management Program, Scott Rosner, and Ian Charles, the managing director and founder of Acros Sports Partners. Acros is a private equity firm dedicated to the sports industry and sports franchise owners. So I'm really thrilled that both of you are here today and joined us on Sportico Live.
Thanks so much for having us.
Well, let's start with the proverbial elephant in the room, COVID-19. So really the effect on valuations is interesting because there's a lot of takes in total opposite directions about this. But at the same time, I find it interesting that amongst the NFL owners, and well, certainly you'd know what the owners would say, but amongst NFL bankers and amongst team executives and really everyone I talk to, and I quote them in the story, they assess the impact as a fleeting impact. And one of the owners I talked to, we quote in the valuations report, and he cites the process for the New York Mets and says that the pandemic is a, quote, aberration. So that's one side of the coin in terms of the thinking. But on the other side of the coin is the fact that Steve Cohen's bid for the New York Mets before our valuations report was released, and when he mentioned this, most recent bid back in December was $250 million higher than that which he bid last week, reported by Sportico. Granted, there are all sorts of reasons that could be involved with a purchase price adjustment, but to counter that, the Boston Celtics LP stake, the minority stake in the team that was sold last month, did not have an accounting for the effects of coronavirus. So really, I'm just curious from a general standpoint where the two of you fall in this debate and what the effect of the pandemic is going to be on team values. So Ian first, and then Scott, please.
Yeah, Peter, thank you very much for the opportunity. We believe fundamentally that sports franchise valuations, the intrinsic value of that business, it is a long-term, durable asset with significant long-term revenue and cash flow growth. And with these assets and that predictability, the valuation, the intrinsic value of those franchises, because of a 12 to 24 month increase in operating losses or reduction in positive cash flow, shouldn't have a significant impact on the intrinsic value of these assets. And in fact, we see that in some of the transaction activity today. If someone is selling control of a franchise in the next 12 to 24 months, there's likely to be some purchase price adjustment for the expected cash flow deficit, if any, on that franchise, but it's negligible. You're talking 0 to 3% by our estimate. So we think these assets, one of the things that's very attractive about these assets is their durability and predictability over the long term, and that's proving out in the current pandemic situation.
Very interesting. So 0 to 3% estimate. Scott, what are your thoughts?
Well, first of all, thanks again for the opportunity. I would agree by and large with Ian. I mean, I think when you look at, this asset class, you really do think of it as, stable, certainly in the NFL, really stable, and one that is largely going to be resistant to any issues surrounding COVID-19. I mean, certainly, is it taking a bite out of your revenues? Absolutely, it is. But the more national you are in your revenue mix, and so you think about TV contracts, obviously, and national sponsorships and things of that like. The more sort of immune you're going to be from downturns, in year-to-year revenue. So, I would agree. Certainly in the case of the Mets and in others, you do have some issues about how heavily levered those teams may be. Certainly now, one of the things we've seen across industries, it's not great for businesses that have been carrying a lot of debt. They're certainly in some more difficult, having a more difficult moment. And so to the extent that may have an impact on purchase price, sure. You may see some owners looking to, get out of the business of sports. But again, we haven't seen a rush to the exits, and I don't anticipate that being the case either.
Interesting. Well, let's ask about another hot button issue and the effects that might have, Scott. I found it interesting that in everyone I talked to, dozens of people in and around the industry and reporting out this story, that not one of them identified concussions and concussion problems as a long-term risk to the point where it would affect valuation of these teams. What are your thoughts about that?
Well, I mean, I certainly think that the short-term threat to the business of the NFL that would be caused by concussions has largely passed, right? I mean, I think that if you look back to when the litigation was ongoing and sort of before we had any real clarity over what that might look like, and ultimately, of course, the settlement of that, sure, you could look at that as more of a short-term, immediate threat to the business. Again, depending on what the size of that could have been in terms of settlement. Long term, I think that the existential threat still exists. I think if you were to look at it and say, and not because of and say that we're going to have a drop off and NFL people wanting to play in the NFL. I don't think that's the case. I don't think there's a real threat going forward of future concussion-based litigation. But what I'm more thinking is in terms of your overall fan base, right? So we know that participation and playing football at young ages and into high school, certainly is the greatest predictor of avidity of amongst fans. And so if you played football, in other words, growing up, you're much more likely to be an avid fan. If that participation level really decreases and continues to decrease, we've seen some leveling off, but if it really does continue to decrease, then long term, we're talking generational. You're talking about less folks who fill in that avid category, and then you could have some real impact on revenue. But certainly in terms of short to medium term, no. Long term, existentially, one could argue the health and safety issue might be the greatest threat to the business.
Well, Ian, moving away from threats, but more to kind of the term I used with Alec, the nuts and bolts analysis of things that affect potential bidders and affect franchise value. What do recent changes to the league's technical requirements for owners mean for valuations over the long term?
Yeah, listen, I think this is a huge theme across leagues. Each of the leagues, in their own way, is trying to broaden out the pool of available control buyers, and they're trying to provide more access to capital for those control owners. And through that process, over the long term, it should drive the cost of capital down for these very durable, predictable assets. And so whether that's expanding the debt limitations, allowing owners in one league to buy across leagues, allowing institutional investors to partner with funds to be non-control sources of capital, all of those initiatives are being embraced in different ways by the different leagues to lower the cost of capital, which in every asset class, if you can drive a systemic reduction in the cost of capital, it leads to long-term valuation appreciation. And so I think it's a very smart move by all the leagues.
So let's talk about some of these specifics in the NFL. The NFL has right now a $500 million limit on the debt that a team can carry, up from $350 million previously, recognizing that there may be an issue for some of these teams, but especially in the case of acquisition, because that limit right now it applies for all purposes for a team. But our reporting in reporting out the valuation story, a source involved in the process tells us that the league is now close to approving a $1 billion debt in addition to the $500 million limit. So it'd be a $1 billion debt limit for purposes of acquisition. There's the cross ownership rule has now been eliminated, where owners like Stan Kroenke can own a team in Los Angeles in football and in Denver and in basketball and hockey. These changes, how significant are they? This is for both Ian and for Scott, in terms of bringing more potential owners to the table and having a wider universe of buyers, because as we talked about in depth with Jerry Cardinal and Stephen Jones in our first Sportico Live, it seems like some of these teams are getting, too big to sell was our euphemism, with a wink and a nod to the too big to fail of the financial crisis. It seems that without private equity being allowed to buy any pieces of the team, without corporate ownership, unlike other sports, there's a limited pool of buyers. So what else does the league have to do to increase potential buyers and therefore increase valuations?
Yeah, I mean, I'll take the first shot at this and kind of lend my thoughts on it. So, I think you hit the last phrase, you hit the nail on the head, right? So the idea is to increase the pool of potential buyers. And the NFL has consistently done that throughout its history. So if you look way back to when it was, hey, you had to have, X% majority ownership, right, to be a majority owner, and that number has been slowly scaled back over time as valuations have gone up. The relaxations that were made on some of the rules regarding inheritance of the teams, right? So to keep the teams in families. And so some exceptions were made and then codified over time. I think that the idea is that, to inflate that pool of buyers in whatever way that you can, yet still keep the kind of heart and soul of the league in place. And so when we think about a potential answer beyond institutional dollars in the way that we've thought about them more recently, is the idea that you could have a public offering of a non-controlling share. We've certainly seen that to be the case in European football and in other places, and where it has had some impact. We've seen it in U.S. leagues, right, in the previous era. So I think that could be an answer for us. But again, the idea is, and I like the idea of the $1 billion rule, although I still don't know if that goes far enough. But the idea that, again, whatever you can do to increase the pool of potential buyers is obviously going to have a positive impact, potentially on transfer prices.
Ian, I'm wondering what some teams do how do some teams leverage their brand to produce greater growth rates than others?
Well, look, as Alec hit on it earlier, it can be challenging because so much of the revenue comes from the national partnership you have with the other owners, right? But locally, things like real estate, events, technology, media, all of those are avenues for revenue and cash flow growth that aren't tied to the National League-driven sources of revenue. And why that's important for valuations, and all of this is interrelated, is that fundamentally any asset's valuation should be a function of the cost of capital for that asset, which the leagues are trying to lower, and the growth of that asset. And if you can lower the cost of capital and increase the pool of available buyers and drive growth rates higher, that should lead to non-market valuation increases. And that really is the opportunity at the local level.
Ian, maybe my most important question of the day, which has been noticed by some eagle-eyed viewers, is that Rambo pop art behind you?
It is not Rambo. It is Arnold Schwarzenegger pop art.
Commander.
I can zoom up during the Q&A session if that's what people want to see.
Well, I thank both of you very much for joining me today. Please do stick around for the Q&A session. And speaking of the Q&A session, we've been receiving some great questions so far. Please keep them coming, and you can ask them in general or direct them to a specific panelist, and I'm sure that they'll be all happy to address. Next up, I'm thrilled that we have as our guest the Chief Operating Officer of the NFL Players Association, Terri Smith. Welcome to Sportico Live.
So much, Peter. Thank you so much for having me.
Now, I've been particularly excited to have you on because something that DeMaurice Smith, the executive director of the NFLPA, touched upon in our first edition of Sportico Live that really piqued my interest, and I've been thinking a lot about it since then. And I wanted to ask you, was he mentioned how the certainty provided by collective bargaining agreements, both the recently expired long-term agreement and now the new agreement that's entered into in March, allows the league to negotiate with third parties. So I'm talking about television partners, other new media broadcast partners, sponsorships, different types of corporate partners with a more solid foundation that in turn allows for bigger deals and trickles down, so to speak, to bigger franchise valuations. So I'm wondering, he talked about that really a lot in the context of the previous years that have brought us to this point of these valuations today. But looking forward, to what extent do you think that labor stability provided in the form of the new collective bargaining agreement will have on these new broadcast deals that the league are trying very hard right now to negotiate going forward? I mean, there's been some reporting, and I don't see quite how they get to this level, but there's been some reporting that deals, maybe notwithstanding the ESPN deal, which is larger than all the others, are going to be double what they were last time around. So how does labor stability really play into that?
I think it plays a significant part. You have several different factors with labor peace. You have the ability to rely on the fact that players won't strike, owners won't lock out players, and the outcome to that is basically no football. So I think that the broadcasters are especially happy about that, especially those who tend to broadcast live events like ESPN. You know, you don't have as much trouble if you're maybe like a TNT for basketball, where those are pretty much your only live events. But, you know, ESPN, I just don't know where they would go with their programming without, you know, these games and some of these things to depend on. So that's a huge factor for them. I think the same is true with our commercial partners and the sponsors of the league. The league does an amazing job of holding a very good image in the marketplace, and labor peace only reinforces that. The opposite of that would have the opposite effect, I think, on some of those bigger deals. So, you know, we're all happy. Also, the length of the contracts that we negotiate with the league, you know, the last two, including the current one, have been for 10 years, where in the past, I think they were hovering around averaging about 6 years in length. So I think that gives additional reassurance as well.
Do you think that has resulted in longer broadcast deals than might otherwise be negotiated?
I would imagine so. Again, if I were on that side of the industry and I was trying to rely on something, labor peace would be one of them, because you at least know that the players in the league, they need each other to succeed. And if I could rely on them working together well for 10 years at a time, that would be important to me.
Okay. So let's talk. I spoke earlier with Alec about hypotheticals. Let's talk about a hypothetical, but it might be more realistic than it ever has been before. And this is in the context of new revenues and how new revenues might be shared between the league and its players. So some background, I mentioned in March, new 10-year deal, as you mentioned, between labor and management. Meanwhile, there's a new frontier is emerging in terms of possibilities for revenue in professional sports leagues, and for the NFL in particular, in the form of legalized sports gambling. Right now, this exists in the form of sponsorships that about a half dozen teams in the league itself has with different casino companies. Caesars, for example, with the league, and different teams. The Raiders have several, as you might expect in Las Vegas, and other teams have sponsorship deals for local casinos in their area. I'm wondering, I mentioned hypothetical, say we're in this world within the next decade, before the current CBA expires, where there's in-stadium bookmaking, in-seat bookmaking, where fans can bet on the next play. This has been an anathema to sports leagues over time. I mean, you can just ask Pete Rose. But say this happens. What provisions, what protections are there in the CBA to define this as football revenue and allocate it the way that you would, say, $1 from a broadcast contract, or are there any?
Well, I would say that there's the general protection first. The CBAs that were in place prior to 2011 refer to total revenue, which were most likely related to football revenue, to use your same words. When DeMaurice Smith came on board, and I came on shortly thereafter, but it was less fanfare, he was very focused on making sure that the players received a percentage of all revenue, which I imagine would include everything going on in the stadium, out of the stadium related to football, in that sense. So there's a general protection that all of it is football revenue, so to speak, and that the players would be due the same percentage. Now, because it's speculative, I can't say that would absolutely be the case as it plays out, because I just think there are too many scenarios for me to kind of guess on. But that's the first one that, again, our perspective is that the league and the teams and the players, everybody has to work together in order to succeed. And I think where we get crossways is basically forgetting that, minute fact. So I think we'd all share in it together.
Okay. And also with Alec, I was talking about some of those old school owners. This was something, I think DeMaurice was more diplomatic than I am. He was talking about last show, Team A and Team B. And Team A really resembled the Dallas Cowboys that did everything to maximize $1. And Team B, at least to me, he didn't say this, represented the Bengals. No naming rights, and running football to, again, as Alex said, nothing wrong with this, but to win Super Bowls and not necessarily to not to leave any money on the table. I'm wondering, how does the NFLPA go about protecting the interests of players to the same extent that are on those two pools? And is that to say, to keep things fair, does the salary cap do all of this work, or are there other mechanisms within the collective bargaining agreement that really levels things out from a fairness standpoint between players, from an equity standpoint? And I don't mean that in the financial sense, I mean that in the legal sense,
right,
between players that play on Team A and Team B. Again, that's me saying what those teams are, not
right. Yes, those are not our words. But no, that's a really, really good question. That fairness and equitability manifests in a bunch of different ways. I would say the first way is sort of the easy way. We listen to our players, And if, players on one team, team A tell us one thing and players on team B tell us another, then we're forced into action in that way. And we really look to the league to do the enforceability with the clubs. We negotiate for all players, for the collective, no matter what team they're on and what team they may end up on. But when it's time to identify an issue or a crisis in some case, then we look to the league to make sure that there's corrective action taken. But just generally speaking, we listen to our players initially before negotiating a collective bargaining agreement or a side letter or any issue of any sort. Mm-hmm. We just try to determine the best case scenario that's fair according to our standards. And we wrap our minds around our scope, wages, hours, and working conditions. And we make sure that we're working with the best case scenarios under those parameters. And then we fight for it. Mm-hmm. And that's what we make sure that, no matter what team a player plays for, or even if he's a free agent, he has the same rights, the same benefits as the guy who was in the locker room next to him. So.
Mm-hmm. And in this new uncertain COVID-19 environment, some stadiums are going to be open to fans. I read that the Colts up to 25%. Other stadiums are going to have 5,000 fans. Other places like East Rutherford, New Jersey for the Giants and the Jets, no fans. Washington, no fans for the entire season, already mentioned. It's a strange new world this year. We've seen different leagues approach this in different ways. From my standpoint, to different levels of success. There's obviously been issues in Major League Baseball with the Marlins and the Cardinals and having 30 different sites instead of one in basketball or two in hockey. So football is going, trying to do business as usual, in quotes, as close as they can. What concerns does this bring to the NFLPA as you look out for those things you mentioned, labor hours, working conditions? I imagine it's been a very strange few months. I know DeMorris mentioned he has all this expertise in terms related to epidemiology that didn't exist previously. How has your job changed, and what are you looking out for now that you didn't previously?
D is absolutely correct, but he dives much further into epidemiology and infectious disease controls than I do, so that's pretty awesome. I think our president, J.C. Tretter, he said some of it best. We just have to sustain. So in training camp, it's everyone there, the players, the coaches, the trainers, team personnel. Everybody's been doing an amazing job, and you can see that reflected in the minimus positive test. It's less than 1%, of the league that's even tested positive during this entire month of training camp. So everybody's been amazing, adhering to protocols. Of course, we have compliance checks. We also have members of our staff that travel, just to make sure that everybody's kind of holding steady. We've been encouraged, all of us, to continue that way once everybody gets back to their home city. So I think that's going to be the thing that is, I don't want to say concerning, but I think that's going to be the factor that we're all on the lookout for. Is everybody still practicing the same protocols? Are people getting lax? Because I see a little bit of that in society. I'm from North Carolina, but I live in DC. And even going back and forth home, I can see the difference, and I see how things have changed. Masks are required here, but not here. Airlines are requiring different things than they did in March and April. So, I just want to make sure that everybody keeps up the same health and safety protocols that, the players fought so valiantly for just a couple of months ago, and that everybody stays compliant, because one person's mistake could affect hundreds of people, if not thousands. So we want everybody to stay diligent, vigilant, and just really sustain so that we can play a whole full season of football.
Well, I think just from my neck of the woods that's the big question, because there's been obviously, without the preseason this year, it's been a very strange run up to kickoff this week, and also the idea that everyone is kind of discussing, the NFL is playing now as if we're over this hump. But what about the second wave, which is already started in some places? What about this idea of the flu season and COVID combining? I think that that there's some question marks about whether the season can be completed. Is that something that that you guys, obviously you've been talking about it, but what is your latest thinking about what to do if there is this pause, or in the case of basketball and hockey, a long pause in the season that we're about to start this week?
We've continued to talk about that. Our medical director, Dr. Tom Mayer, has been super, super helpful, and in particular in emphasizing the novel and emerging part of this infectious disease. So it's something that's always at the forefront of our minds that, even with what we know, we feel pretty good about the protocols that we put in place, but there's so much that we don't know, and there's so much we have yet to see, which is probably not a good thing. So we've been talking back and forth about what we can expect. We do have provisions in the COVID amendments for partial seasons, half seasons, just anything that could happen with that, so that the players can know what to expect in those scenarios. The only thing that I can't really speak on is what happens on the NFL side. I don't know if there's a point where they cancel games or postpone or move things around. That's kind of more their bailiwick in terms of competitive balance and their broadcast agreements. Those things I just don't know. But on our end, we've done our best to protect our players against what could be a season full of losses in that way if we're not able to, play a full season, or if, a set of players take a particular hit or find themselves in precarious circumstances, like if there's an outbreak in their house for some reason rather than on the football field. So those are the type things that we've been trying to protect against.
Well, Terri Smith, thank you so much for joining us, and please stay right there. And I'd like to ask all of our previous guests to join us again for some Q&A. But I really appreciate that insight, and I think that it's a strange new world. And hopefully Ian's right, and there's this 0 to 3%, if I'm remembering correctly, effect. And years from now, we look back at this the way that old school hockey fans look back at the canceled Stanley Cup from 100 years ago. But it's anyone's guess. So I'd like to ask Nick Peacock-Smith, our Director of Live Events at Sportico, to join us now. There he is. Nick, from my Brooklyn brother here, joining us from Bay Ridge. And why don't you ask some questions from our guests, from our viewers for our guests?
Yeah, of course. Thank you so much, Peter. So this is one I think it'd be interesting to get all of the panelists' opinions on. For NFL teams, what are the primary sources of revenue in 2020?
Ian, why don't you?
I was going to say, I was going to defer to Alec, but it is overwhelmingly the national media and sponsorship contracts. And it's not even close. Depending on the franchise, that's going to be somewhere between 70 and 90% of the revenue.
That's what I was going to say.
We were texting the answers to each other. It's fine.
New deals that I was discussing with Terri, so important because, if national revenue represents such a large piece of the pie, and these revenues are going to increase, dramatically, potentially, based in part on that labor piece we were talking about, that really puts the onus, as Alec was saying earlier, on local markets to figure out the ways to reduce this widening gap in valuations that we're seeing between the big market teams and the small market teams. Nick, why don't you hit us with another question?
Sure. So what do you think is the future of PSLs, considering the comfort and technology of the stay-at-home experience and the disappointing recent numbers for some teams in the NFL?
Alec, why don't you take a stab at this one?
Look, I think PSLs are always going to be driven by how much demand there is for a certain team. I think you've seen that in Las Vegas. I think there's way more demand than there is supply. I do think people will get more and more creative with PSLs and turn them into more like memberships and personal seat licenses and have different perks that come with those. But I think historically, when you've got a lot of demand for tickets, PSLs are fine. When the demand for tickets goes down, it's much harder to sell a PSL.
I see a question has come in from our very own editor-in-chief, Scott Soshnick, and I'm curious about this as well. So, Scott, why don't you take a stab? But I think Alec might have some interesting perspective on this too. How big and realistic an opportunity is there for international expansion in the years to come? We've seen the Jaguars play a game a year in London. There's been other games in London. The Jaguars were planning to play 2 games a year in London, but that's obviously very different from expansion. Maybe you've picked up a faint trace of my Canadian accent from 20 years ago, born and raised in Toronto, City of Champions. But the thing is, the NFL's not coming there anytime soon. So where would they go, Scott?
Yeah, no, it's a good question. I mean, I think that one of the things we've talked about with international expansion for the last 20 years is it's always a decade away, right? The international expansion is 10 years from now, and it continues to be pushed down the road by 10 years. But I think I think the focus really has been solely on European expansion. And I think instead, if you look south of the border, I mean, I think it's certainly plausible to think that you could see Mexico City with a team, going forward. I just think it's one of those, it's really a question in London. It's not so much about fan avidity anymore, whether or not it exists in the marketplace. I think it's really grown over time. It's really more a practical application of how this might work, in terms of travel, in terms of bringing in players on off days, for a look as a free agent kind of thing during the season. Those things can be figured out. But again, the NFL has always been about competitive integrity, competitive balance, and you don't want to be setting up a team for failure. I think if you look to Mexico City as an example, you don't have those same kinds of issues in place with respect to travel, with respect to time zone differences, what days off might look like. They still exist, but they're far lower in nature. So I would think that might be the next logical place. But we'll see. I don't think it's going to be 10 years though at this point.
Nick, why don't you?
Yeah. And they have taken NFL to Australia, my homeland. So we can talk about that too. But what are the biggest threats? In all your opinions, what are the biggest threats to a franchise's valuation growth? Looking ahead.
Alec, any thoughts on that?
I think if you look over a 20-year period, you'll see teams kind of rotate through the rankings. And the biggest threat is you don't win and you don't operate well. Because if you don't win, your brand value will go down over time. It's inevitable. And because you're not relevant, you're not shown on TV in the right spots, you don't sell as many tickets. And it's slow, but if you go back and you just look at where the Washington Redskins were in 2000, they were atop the Forbes valuations. They were the most valuable sports team perhaps in the world, and they're not that anymore. It's not like it's been such a significant fall, but it does show the impact of not operating well and not winning on the field. And so, the most important thing really is run a good business. Think of it as a good business on the business side and on the sporting side, and then you'll retain your value in the market.
So a question for Terri. Can you discuss the movement by teams in the NFLPA into esports and gaming from the owner and union perspective? So I guess for you, from the union perspective.
Sure. That's a pretty broad question. I think we would probably move into it just with the start of maybe licensing. We have several partnerships, but our biggest one is with One Team Partners. And we focus a lot on investment, name, image, likeness of our players. And that's the way I could see we could move into the digital space a little bit more. In terms of other esports and gaming, I mean, I'd leave that probably for somebody else to speculate on, but I know that we're kind of at the brink of an entry point there, but we haven't, we just stuck our toe in the water. We haven't really dived all the way in. So,
and I have a question for Alec that I think is kind of a natural with your experience, but I'd be really interested in Stephen's, in Scott's take as well. We asked Stephen Jones last Sportico Live about how much would the Cowboys fetch on the open market. So we valued them at $6.43 billion. I prefaced that question to him, or our editor-in-chief, Scott Soshnick, prefaced that question to him by saying what we count in this valuation. So we count the team. We count the real estate owned by the team. We count the Star facility in Frisco. We count the ability to operate the stadium in the AT&T Stadium, albeit they're not the actual owners of that, the ability to operate that. We do not count things like their investments in tech startups unrelated to the core football team, or licensing ventures for Blue Star land holdings or subsidiary that might use the Cowboys likeness but not necessarily have to do with the team itself. So counting the things that we looked at, we said they were worth $6.43 billion. There's a limited pool, as we were discussing on the panel earlier with Ian and with Scott, about people who could actually qualify to buy these things. So Alec, if it was for sale today, our fair market value aside, what would someone actually be willing to pay to buy this team? And Scott, I'd be interested in your sense as well.
Well, let's start with the question of who would be eligible to buy it. Because as Ian discussed earlier, if you had public institutions or even kind of private capital eligible, or you had international capital eligible, then I think it opens up the market a lot. And then in terms of the valuation, look, the Cowboys are a combination of a great business and an incredible piece of art. And so there's a way to justify a valuation in excess of $5 or $6 billion just by looking at the business. I'm confident of that. The question is how much higher it gets based on the art portion of it. And my guess is it would go substantially higher than that because there's only one Dallas Cowboys in the world.
Yep.
I would wholeheartedly agree with my old friend from Lower Merion. I would say that, to quote one of my colleagues, Tom Cerny, life's too short to bet the under here. I would think that the over would absolutely grab it. The competitive bidding dynamics would be, I would imagine, would be pretty vigorous. And whether it's an international buyer, a wealthy domestic buyer, I mean, this is the trophy of all trophies, right? In the sports world. So, it's a little bit like a souped up version of the Schwarzenegger art behind Ian, right? Right. I mean, but I certainly think that the over would take it for sure.
There you go.
I would say, for the record, that when we asked that to Stephen Jones, he punted and wouldn't answer. But Jerry Jones has said several times that he wouldn't sell for anything less than $10 billion in recent years. A number that seemed, astronomical and fictional at some point, but now maybe not so. Nick, why don't you one final question for our team from our viewers?
Absolutely. And Ian or Alec, but also Terri and Scott, feel free to take a swing at this. Can you remind our viewers what leagues allow companies like theirs to purchase ownership in teams? If there is an interested investor who wants into their private or public funds, how can they engage and invest?
I'll let Alec handle that because I'm not allowed to talk about that.
I probably shouldn't.
Yeah, Alec probably shouldn't either.
That one will Well, Scott can talk about that.
I'll move to a safer topic then. Given the 2020 and how all the sports calendar has changed, what will be the effect, if any, with the NBA finals coinciding? Obviously, baseball's still happening with the NFL TV programming as the season starts this week.
Scott, why don't you take a stab at that one?
Yeah, I mean, I don't think it'll have much of an impact. I think it kind of depends on the teams and what game it is in the series if they go head to head. Depends on the teams that are in that series. But by and large, look, I mean, the NFL is still, the gold standard when it comes to media properties and, dominates the top 100 of shows watched every year. I don't think that's going to change a whole lot this year. They're less immune to dud games, if you will, bad matchups and what they're facing in a game 7 kind of thing from an NHL and NBA. But overall, I don't think it's too much to worry about.
Well, I want to thank all of our guests today. Ian, it looked like you had a final point you wanted to make.
I just wanted to leave with something super positive because Terri actually dropped some data that I thought was fascinating. During the entire camp process, she said they had less than a 1% positive test rate in the NFL. We've all read about the success of the 2 bubbles. Even Major League Baseball, where there's been a lot of attention, has had over 104,000 tests and only 55 players test positive. That's less than 0.1%. Like, there is real leadership in protecting these players and something to really latch onto for some hope and a path forward here. And I just think sports doesn't get enough credit for that. And I just wanted to thank Terri for sharing that data.
Thank you.
I'd also like to see, a no-holds-barred match between the Schwarzenegger Commando behind you.
I should have gone with the green screen today.
the 12-foot-tall Incredible Hulk in front of Alec knows what I'm going to say.
Yeah.
Entrance.
That's right. The RedBird Hulk. He's big.
Next time it's going to be Sportico live, superhero crossover edition. And I do want to thank all of you for joining us, and thank you to all of our viewers for giving us a part of your day today. We really appreciate it, and we look forward to seeing you next time. We will keep you posted on when our next event is and what the topic is. But in the meantime, please continue to visit sportico.com for all of your sports business news and watch our newsletters every day. And we look forward to seeing you soon. Goodbye, everyone.
Bye.